we will get into our market update. We always do a market update before we start our seminar because the real estate market changes. It changes month to month and it changes week to week. What we want to showcase this week, though, is prices in the bigger markets in Canada are a little bit different than the prices in the market that we're in. And what you can see on this slide is Vancouver and Toronto, and it's the house price index, which means if you in 2005 the prices, you can set them at the 100, and then over the last, I guess it would be almost 20 years, it would be 17 years. Yeah. Those prices have moved up, as you can see, almost 380. So they've gone up almost 4 times. Yeah. Or sorry, 3 times in value. And if you see the graphs for Toronto and Vancouver, they've got a very, very steep curve. Yeah. Their prices in 2005 were very, very close to Calgary price. Vancouver was a bit ahead. They were around 600. We were about 400. Toronto's average price back then was about 450. So we were very close price-wise to Toronto. But you can see in the successive years that those prices have just ballooned. And the average price there on the bottom of the screen for Vancouver, 1.155 million. Toronto 1.110 million. Those are priced at the end of September, the latest time that the National Bank has accumulated the stats for. So we have one more month in there, and we think the prices have gone down even more. One other thing that I want you guys to look at is if you see the top of these graphs, they peaked probably at the beginning of this year, maybe the end of last year, and they're really, really starting to fall in the larger markets because they went up too high, too fast. And now we're seeing the average price start to come down quite dramatically, actually, in those 2 big cities. Now, what we want to contrast that with, let me just let someone else in here. What we want to contrast that with is the Alberta market. We've got here Calgary and Edmonton. You can see that our price gains over those years are nowhere near as steep. Calgary's is a little steeper than Edmonton's. Edmonton's is almost relatively flat over the year, which is kind of surprising because they've seen the population growth, the same population growth that Calgary has. But you look at the peak here. I hope you can all see my little cursor. The peak for Calgary, we still haven't started to fall. And that has to do with the supply issue that we were talking about in our tip of the month. Yeah. So tip of the week. Yeah. So we don't expect Calgary to fall at all. We expect it to just keep going into the spring market, and then we expect it to actually take off. We're expecting to have a very, and it happened this year, like during COVID. I mean, it happened all over the country, but we think Calgary is going to have this massive, massive surge. Because you look at what's happening in Toronto and Vancouver. I mean, I was watching the news today. There's strikes out in Toronto and Ontario. And why is that happening? Because inflation's happening. You look at the prices out there. People just can't afford it. So why be a teacher out in Ontario when you can come here, live for half the cost, basically, for housing, and do the same job you love? So, and we've seen this. We've got clients that are policemen coming here. We've got just normal people. We have IT people coming here. We think Calgary, it's going to be tremendous for our market, and it may happen a bit later in the year. It may happen a bit earlier, but we know it's going to happen. Yeah. So that's, and one more thing we want you to look at is the average price at the bottom there. Calgary's at 516. Edmonton's only at 382. That actually surprised me that they're still that low. And now that's through all housing types. So single family homes will be a bit higher than that. But, 382 is actually very, very affordable still. And, Edmonton is more of a blue collar city compared to Calgary. Calgary's more white collar. We've got the office towers behind us, all the oil company head offices. So we attract a lot more white collar workers. So hence the real estate is going to be a little bit more expensive. But contrasting those 2 prices to the over 1.1 million for the 2 largest centers in Vancouver and Toronto, Calgary still and Edmonton are still very, very affordable city to live in. And I came across a news article just last week where, Azad and I were always marveling at Canada wanted to bring 450,000 immigrants in every year. Well, they've upped the ante now. Trudeau wants to bring in more than 500,000 immigrants every single year.
Wow, that's amazing.
Yeah.
There's a rumor he's trying to buy votes there. But anyway, we're not going to get into that. But Tim was looking into the Ottawa market, Montreal market, and they were still above Calgary's market. And one thing Tim had to look into further during the week, Edmonton does have more to multifamily. So there are way more condos in Edmonton to keep that price down. But 516,000 average for Calgary. We're banking on getting to 650,000. We can't believe it's not there already. So Tim, we're looking within the 3 to 5 years. That's where the Calgary market is definitely heading, and it will probably be sooner than that.
Yeah, so that's our real estate market update. We want to get Danielle, and Danielle DeMarco's our real estate mortgage expert. She not only helps you get a mortgage for your rental properties, she helps you develop a real estate investing plan to carry you forward.
Yeah, I mean, Danielle was helping one of our clients today, and a typical email from Danielle is, this client wants to buy 3 houses. This is how we're going to do it. This is the first purchase, second purchase, third purchase. We have all our price ranges, and then we have a 3-year plan on how to get there. I mean, she doesn't just do mortgages. She does a plan for our crew investors, and it's really working out.
So take it away, Danielle.
Thanks, guys. Yes, so I tonight am just going to be here really quick. You guys have a lot of good information to share, so I won't take up too much time. Just to give everybody kind of a quick market update as far as interest rates go. December 7th, the Bank of Canada will be meeting again, so that's about a month away, and we are anticipating an interest rate increase by at least a quarter point. So again, that's the overnight lending rate, which affects prime. So this means that prime right now is sitting at 5.95. So if we see that minimum quarter point added to that, then the new prime is going to become 6.2. So this means effectively that for home buyers, qualifying is going to come down potentially a little bit. And for homeowners, payments are going to come up. But what I wanted to address tonight is for any of you that are looking at investing, to not be afraid of where the interest rates are at. So as far as cash flow goes and interest rates, it's still the right time to purchase because, as Tim and Azad mentioned, they're sourcing out very specific properties for you. You're not, sentimental buyers that are heart into these properties. You are looking at numbers and math and cash flow, and they're looking at numbers and math and cash flow. So when the perfect property comes along, it doesn't matter necessarily what interest rates we're at because it is going to cash flow. So properties that have more than one unit are going to be, a great buy right now. Whether it's an illegal suite or legal suite, as Azad Tim mentioned already, our rental market is already higher than normal. So we can charge those higher rents currently while these interest rates are a little bit higher because it is buyers to purchase. So we are expecting interest rates on the fixed side to be coming down at the end of 2023 and into 2024. So we're also talking about short term here, maybe a year and a half, 2 years of these higher rates. So they also said something that I love, which is, getting into the market. And I preach this all the time. You can't time the market. Getting in, you're never going to regret getting into the market. What you're going to regret is in 2 or 3 years not having gotten into the market, because even though we do have a little bit of higher rates, you can demand more rents. You can buy properties with multiple suites to get that higher rental income and still cash flow. Meanwhile, if someone else is paying down your mortgage, you're building up equity in the property, your principal balance is coming down. So in a couple of years, you're not going to regret the fact that you got into the market and have this asset. So getting in is still critical, whether rates are at an all-time low like we saw a couple of years ago, or whether we're just kind of above that historical average, which is where we're at right now. Timing the market doesn't work. I've mentioned this a couple of weeks ago. I also did an interview for a news channel last week on the market and these rising interest rates, and I stand by what I said. Timing the market doesn't work. Last year, this time of year, September, October last year, people who were trying to time the market and held off today can spend about $120,000 less than they could have last year. So those people are regretting not having gotten into the market because they can't qualify for the same purchase price due to the interest rates. We're also seeing a lack of supply, as Tim and Azad mentioned. So that means that we're not really going to see these house prices coming down. So there's this perfect storm of people that are going to be holding off, that are emotional buyers, so that us as investors can be looking at the math and scooping up those properties right now, even though rates might be a little bit higher. And another trick of the trade is if you take a variable rate right now, for example, obviously depending on qualifying and depending on each person's individual situation, but if you take a variable rate, we can always look at when the rates start to come down at the end of 2023 into 2024, switching from a variable and locking into a lower fixed rate. So again, that short term, we might have a little less cash flow, but when we hit that, 2-year mark and we can hopefully lower down those rates and lock them in, then all of a sudden we've got that bigger cash flow again. So again, getting in is going to be critical. These rates are not going to be here for forever. Probably that low to mid 4% range is hopefully where we're going to end up in that 2024 year. So again, get in, come up with an investment plan. Azad's right. The goal is, if you're investing in properties, is to figure out what can you afford, how many properties can you afford, in what timeline. And then our job as a broker is to kind of package it all together and figure out, okay, what lender are we going to go to and why, to help you accumulate those properties. So if you stick to the investment plan, if you follow and listen to your trusted advisors who have been doing this for 16 years, 20 years, you will come out on the top for sure. And that's it for the market update today, guys.
Awesome. Thanks so much. If anyone has any questions for Danielle, just put it in the chat. She'll monitor for a little bit, and then I know she's taking off. So her contact details are here as well. Danielle's go-to mortgage planner.
Yeah, thanks again, Danielle.